Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, and joining me on the Market Site desk, we have Sandip Bhagat, Chief Investment Officer of Whittier Trust, Kate Howe, founder of Happy Mango, Chris Dearborn, Managing Director on Nasdaq's Market Intelligence Desk, as well as Michael Normyle, Nasdaq's U.S. Economist. We're here to discuss the fundamental factors that are impacting economic and market outlook. It is great to have everyone with us. Welcome to Trade Talks, and we'll start off with you, Sandip. High-level overview of where we are right now with the macro backdrop.
So optimism has gone up as the year came to an end. The odds of a recession have receded significantly, and yet investors cannot shake off some lingering concerns. The yield curve is inverted, leading economic indicators are headed lower, bank deposit, bank loans, money supply growth, they're all negative. People fear that the adverse effect of Fed tightening will bite this year. It's right around the corner. The last mile of disinflation will prove elusive. The Fed will make a mistake. There are all these concerns lingering, Jill, and yet we have a constructive view to counter each one of these concerns. So I'm fairly optimistic, able to rule out a traditional or a deep recession. And actually count on growth, which will continue to slow down, but still remain positive.
Right. So slowing but growing, which is a good thing. Well, Kate, it's interesting. I was reading the Charles Schwab sentiment survey that comes out quarterly. Investors and traders are as positive as they have been with their portfolios and their money situation since 2021 when the survey was launched. Yet they are negative on the economy and the strength of the consumer. It seems very counterintuitive when you're happy with your investment portfolio, but you're, a little bit bearish on the economy. From a small business perspective, do they share as much optimism as Sandip does?
I think that it kind of generally echoes this phenomenon of kind of a lot of mixed signals. In the small business space, and there are larger small businesses, there are the smaller small businesses. So from what we see, where Happy Mango, we've served the smallest of the small businesses. And from what we see, there's still a lot of demand, very strong demand and very strong supply in the credit space. And I think that coincides with a record number of new business registrations that we've been seeing in the last 3 years, year on year. So on the smaller side of the small business, we still see a lot of optimism.
Yeah. And Michael, from your perspective, when you think about money supply and deposit growth and credit, and we tie this all together, do you share a bullish view, or are you a little bit less optimistic in terms of how that looks as it relates to businesses?
Yeah, I do think that those are certainly worrisome trends. And another factor that is a little bit concerning too is commercial and industrial loan growth has been slowing. It's gone negative recently. And so if businesses can't borrow money, then they're not going to be able to invest in their business and expand their business. So that's always a concern for economic growth in the US. And there's a bit of a demand issue and a supply issue where we've seen from the Fed's senior loan officer opinion survey that banks have been less willing to lend over the last few quarters. And then naturally with interest rates going up, that the demand for those loans has turned down a bit too. So that's an area of concern for sure. And kind of adding on to your point, I've seen we got the JOLTS data today, the job openings data, and that I've seen that split up by small businesses and larger businesses, and you are still seeing a lot of the demand there for businesses with 1 to 9 employees, where even though we saw overall that demand for labor has been coming down, job openings, hires, quits, they've all been kind of trending lower. If you look at it by a subset of the 1 to 9 employees, their job openings are really holding up and hires are also really holding up.
Right, but when you have that small business faction and cost of capital is expensive and banks are less willing to loan, you need capital to grow the business. So from Happy Mango's perspective, this is the sector that you serve. How are you bridging that gap if they can't get lending?
Yeah, that's a great question. If we look at the overall banking industry data, there's a slower demand and slower supply in the commercial and industrial loans. But in the smaller business space, luckily there's a growing number of alternative funding sources that are stepping in and filling the gap. For example, a lot of our clients are community-based loan funds, and they have been very active. And I think that one of the benefits of the PPP loans is putting a lot of these loan funds kind of on the map, making them better known in their community, and we've seen a lot of growth in lending from these lenders.
Yeah, and Chris, from a market perspective, it still seems to be digesting this news in stride.
You know, it's still a dichotomy, even though over the last 2 months you've seen a big run up in a lot of the small cap names. So shifting from like the smaller business to the market general, right? You're looking at everything's hinging on what Powell says. And he's up on the Hill again today, basically said the same rhetoric that he continues to say, that they are, the path of the economy is going to lead when they're going to start to cut rates. And you know what? The repricing from December, when the market started to really rally with a March cut, to saying, you know, we're now looking at maybe a 60% cut in June, but really that might change again to July, really for the first time, but which puts you right in place with the depth plot, right? So now you're looking at 3 to maybe 4 cuts, depending on what the economy does. What does that mean for stocks, right? And what does that mean for bonds? Well, yields are ticking a little bit lower. You know, the 10-year is probably going to settle somewhere around 3.8 to 4% on a yield basis when it's all gets said and done. Inflation's never going to really go away, but we're going to get closer to 2% across the board. Can the economy really withstand that? Meaning, can consumers stand that? If the recession stays away, wage growth continues to happen, people will continue to spend, and you've got a political hurricane, tsunami coming in a couple of months, right? Which we just went through 4 years ago. And you know, all bets are off when that happens, because it's going to be mudslinging all over the place. If the Fed doesn't get their policy straight and put on the path before that happens, the markets are going to be extremely volatile. And you have narrow leadership right now, but really it's kind of a function back and forth. It's an ebb and flow over the short term. You know, the Russell 2000, which is a better gauge of small cap, and the Russell Micro, which is a better gauge of the micro and small cap numbers, are up more. The micro cap is up over 30%, with the Nasdaq 100 is up about 27, 28% year to date. The Russell's had a fantastic start to the year, up over 28%. The S&P 500 continues to make higher highs across the board. February was just phenomenal. You know, is it because it's NVIDIA and the Magnificent 7 or 6? Is it because Costco just keeps selling chickens to everybody? You know, the question really is, you know, people are spending, but where are they spending? And AI is the catapult for all this. I mean, look at the alternatives that are going, you know, Bitcoin, the other alternatives are all making all-time highs as well. So to the original point that you made when you started with, people are confident about the portfolios. They are, because they're seeing profits. Are they concerned about the outlook for their job security? Yes. So that problem is going to come to a headway at some point, and that's going to make investors jittery. And whether it's politics or a delay in the Fed bringing up the interest rates, we'll wait and see.
Well, Sandip, he had mentioned AI, right? I mean, all the buzz is around AI. Where are we going to get earnings growth? Where can you potentially exceed expectations outside of the AI story?
Investors are very bearish on the earnings outlook. We've had 2 flat years of earnings growth. This year, the projection is for 11% growth, and people are highly skeptical. And I'll summarize this with one concept. Just like the last 2 years, high inflation was a headwind, both for economic growth. It also took its toll on profit margins. High inflation raises your cost of goods sold. Businesses are unable to pass it through in the price of finished goods, and so margins compress. And that dynamic is about to change. The headwind of the last 2 years is now going to become a tailwind. We're looking at low inflation, and therefore margins will expand. And every single time in the history of the US stock market, when earnings get either cut or stay stagnant, they inevitably bounce back to a trend line level, and earnings today are way below trend line. So I might be in the very rare minority that expects earnings expectations to be not only met, but perhaps exceeded.
Yeah, well, I mean, and to your point as well, they're going to comp certainly much better over, you know, the past year or two. But Sandip, when we see, you know, you and Chris are in agreement that we could see inflation come back down to around 2%, still feels like things are very expensive. I mean, rents, insurance.
Yeah.
You don't think about it, you know,
it's
insurance.
total inflation. You look at 3 years, it's up over 25%, give or take.
Right.
Right. I mean, that's the real money right there. It's not like a 2 to 3% creep every year. 3 years, we're up over 25%.
And we're not going to get back down to
or 50,
levels.
yeah. You never see deflation, right? It's such a rare phenomenon. And when people say, well, we'll have inflation of, say, even 0, that means these high prices are going to stick
right.
forever.
It could be 0 year over year, but it's still higher than it was 3 years
by
ago.
25, 30, 50%. So, so look, that Luckily, incomes went up, so people are able to counter that. I see a lot of angst in the market, and Chris, you spoke about this, about the Fed, right? I find it a touch amusing that the market swings from pricing in 7 cuts to 3 to 4, March, June, July.
It's the headline, talking heads.
Correct, but look, if inflation does come down anywhere close to 2%, let's even say it's 2.5%, the Fed funds rate is 5.4%. That's 3 percentage points higher than where inflation is headed. That is way too restrictive. The normal spread above inflation is 0.5%. The Fed funds rate will be at 3% sometime in the next 2 years. So do not fret whether they do 3 this year and then 7, or 4 and 6, 5 and 5, 6 and 4. To come down from 5.5 to 3, that's 2.5%, that's 10 rate cuts. You will see that. If you must worry, think of what about inflation is changing to prevent inflation from going to 2.5. But what the Fed does or doesn't do, irrelevant.
Right. Well, I mean, of course, if you had to pick or choose, do you want your rate cuts, Michael, or do you want to have a healthy economy where consumers are spending, the job market is healthy? I mean, just to satisfy the market's narrative, I don't know. I'd rather be employed and have a healthy economy, right?
Yeah, exactly. But the Fed has been very adamant throughout this whole multi-year process that they're getting inflation to 2% essentially, right? So they've been able to have this kind of nice Goldilocks kind of economy situation where the economy's doing well, inflation's coming down, but their ultimate goal they've never wavered on is getting inflation back to 2% because Chair Powell believes that if we want to have a long expansion, we need inflation at 2%. And if that, the risk used to be that we were going to have a recession that eventually got inflation back to 2%. Now that looks much less likely, but the idea being the whole guiding principle here is that we need low, stable inflation so that we can have another 10-year expansion, essentially.
Right. I'm going to talk technicals here for a moment, Chris, right? Because price action is going to confirm what the market thinks it's thinking, right? So we'll pull up our first chart here, S&P 500. Let's take a look, over the past year.
Real briefly, I mean, we talked about before, it's, February was a month of higher highs, all above 5,000 record numbers, et cetera. And you finally got up to about 5150, just shy of it, and it's pulled back a little bit there. But if you look at the index itself, what's really driving that? You've got multiple sectors making higher highs, but you really got a handful of names that keep pushing throughout that sector, that index. And if NVIDIA is going to continue to make higher highs, Microsoft is still going to continue to move higher. You're going to look at on the dollar valuation, not the market cap adjusted. It's going to be significant. Look for the index to pull back here. You've got major support at 5,095, 5,060. The 50-day moving average is just below 5,000 at 49.08. What I find interesting, if you look at the bottom of the chart, is the relative strength index, right? A reading above 70 is an overbought condition. A reading below 30 is an oversold condition. We've been bumping up at and above that 70 level for this entire run up since the October lows, and we haven't had a major pullback yet. We've pulled back and dipped a little bit, but that's a consolidation, again, that ebb and flow of the marketplace. There's not enough of a pullback here. I'm nervous looking at this chart, but there's no reason for me not to buy it. It's still going higher.
Right. Well, Michael, I want to talk about the yield curve for a moment here. Historically, it's been somewhat of a reliable predictor of recessions. Strategists and economists were pricing in a recession last year. 85% of them were wrong. So do you necessarily think that this isn't relevant, basically?
Yeah, I think its usefulness has kind of waxed and waned a bit. For one reason, the lead times between an inversion and recession can be quite varied. It can be a few months, it can be 3 years. And then, of course, it inverted in 2019, which counts as predicting the 2020 recession, but obviously that was COVID related. Would there have been a recession without COVID? We don't know. So is that really an indication? And then the kind of bigger change, if we're looking at this going back to the 70s, is the Fed, they weren't always so transparent with their forward guidance. And you can argue that right now, the Fed said we're going to hike rates to get inflation back to 2%, and then we're going to cut rates. And so that would lead the market to price in, if they're believing the Fed, an inverted yield curve, essentially. So in that sense, it kind of makes sense that we have an inverted yield curve.
Right.
Jill, if I might.
Of course.
It's so dangerous to say this time it's different, but a couple of thoughts come to mind. First of all, the US economy has somehow just become interest rate insensitive, right? 11 hikes, 5.25%, the economy keeps chugging along. And I think what happened was not just with the post-COVID monetary stimulus when rates went down. Remember, you had the global financial crisis prior to that, and for a decade, you had really low rates. So consumers and corporations have locked in low fixed rates. Their exposure to variable rates is just simply not as high as it used to be. And normally high rates and high borrowing costs would lead to demand destruction. And this time, the legacy of the post-COVID stimulus, the fiscal stimulus, was people had big excess savings that allowed them to keep spending. So you just didn't see the demand destruction, which the yield curve is predicting implicitly in predicting that
I mean,
recession.
and that's an excellent point that you make. I mean, that's what we're seeing in the housing market. If you got your mortgage rate 4% sub, as I did, I'm not
You
thinking
ain't
about
moving.
selling. A mortgage will be almost double of what I paid. So,
So Kate, I want to ask you, with the smaller companies, you know, we've discussed this multiple times here about the cost of capital and how hard it is, especially for smaller companies or cash burn companies to raise capital. Are you seeing companies raise money on a longer term basis or shorter term basis now with 5+% nominal rate?
Well, from the borrowers on our platform, they tend to be the smaller, the coffee shops in the Bronx or a bakery, right? So a lot of 80% or more of the borrowers on our platform have no employees. A lot of them have 1 or 2 employees. So that is the segment that I'm looking at. And we see a lot of strong kind of demand in that space. And if all of us are in agreement there will be rate cuts this year, it will be generally a favorable, very favorable environment for these borrowers, for these businesses. And there are also a growing number of resources for them. I think a lot of them prompted by the government and their state-related sources or federal government-provided resources to help these businesses to build from the ground up or expand. So I think from that segment, I think if we continue to see what we're seeing in the rate environment, I think it's going to be great for these businesses.
That's always good to hear because we've talked about before, a lot of the companies that we've talked to, especially on our desk, the concern of raising capital in Q3, definitely not as much Q4, more in Q3 of last year, was that you're going to be taking a 30% haircut because it's going to be a lot of hair on some of those loans at the beginning. It's not really even loans. They have to go through tertiary banks to kind of get some, and it comes with a warrant attached. You're looking to raise, $100 million, you're really only getting $70 million now. We're in a zero rate environment. You were getting closer to 90, 92 million on that with the fees. So people were taking short-term loans to kind of bolster their spend until things started to settle in a little bit. So it's kind of interesting to hear from the smaller side of companies, especially with the government stimulus coming in, still spending, but in a good way, I think, it sounds like.
The economy is always driven by the small companies. Job growth in that segment means a lot more to the economy than anything else.
all right, we will end it on an optimistic note. Appreciate everyone's insight. Thanks for joining us on Trade Talks. And thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.